You're now listening to episode 68 of the Real Estate CPA podcast.
Your source for all things real estate, accounting, and tax. Here we reveal our secrets that can save you thousands in taxes, streamline your accounting process, and help grow your business. Stay tuned to hear insightful interviews with industry experts, successful real estate investors, and current clients on what strategies they use to grow their business and how they steer clear of Uncle Sam.
Hi everyone, thanks for tuning in. Thomas Costello here today with Bill Manassero, multifamily real estate investor and host of Old Dawgs REI Network podcast. In today's episode, we'll discuss Bill's story and how he got started in multifamily investing, the importance of systematizing your business, emerging markets, and so much more. Bill's also giving our listeners a free report, 12 common mistakes real estate investors make and how you can avoid them. Link will be in the show notes below. Before we jump right into today's episode, I want to let everybody know that the Real Estate CPA will be putting on special virtual workshops in October, November, and December of this year, where we will discuss year-end tax tips for the first 15 to 20 minutes and then open up the room for questions. This is the perfect opportunity to get answers to your last-minute tax questions before the year ends. Seats will be limited, and you can sign up by visiting www.therealestatecpa.com/virtual-workshops or by following the link in the show notes below. But that's not all. We heard your feedback from last year and created a personalized year-end tax planning service for new clients that includes one tax estimate, a call with one of our tax strategists, and a written year-end action plan that includes the steps you'll need to take to implement any last-minute tax strategies to minimize your tax liability. If you're interested in this service, head over to www.therealestatecpa.com/year-end and fill out the form located right on the page, and Brandon or myself will get back to you within 1 to 3 business days to schedule an initial consultation. If you're already a client, don't worry, we'll be sending out year-end tax planning emails to you over the next few weeks to schedule your year-end tax planning call. But feel free to contact your tax strategist to get a head start on the process. And without further ado, we'll jump right into today's episode. Bill, thanks for taking the time to come on the show today. Can you give our listeners a little bit of information on your story and why you decided to become a real estate investor?
Well, it wasn't intentional. It wasn't something that I really expected to do. I actually, my family spent the last 12 years at Port-au-Prince, Haiti. And we have a nonprofit organization called Child Hope International. We work with just street kids and abandoned, orphaned children on the streets of Haiti. And so we were in Haiti, and it was we'd been there for quite a while. And we were looking at coming back to the States, and just kind of assessing if that's what we really wanted to do or not, or if we were going to stay there. And so anyway, there's a lot of issues and dynamics going on. But basically, I was, looking at, well, if I go back, what am I going to do? I was already like approaching 60. I thought, well, I'm not going to run around with a resume and try to find some sort of job. I'll end up with a blue vest at Walmart probably, So, what can I do? And I started just examining, the various things, because I'm too hyper. I got to do something. I'm not a person that's going to walk around and collect seashells and, Laguna Beach or something. So I was like, looking at options. I actually started looking at online businesses and was looking at sort of these drop shipment sort of businesses and so forth. And anyway, so we started while we were in Haiti. It was real successful. It started going really well, and then we got kicked off of eBay, and it was like, oh man, there goes the whole model, Yeah. And so I'm going, this is not good, And then I just got this unexpected check, an inheritance check in the mail. And I was thinking, what am I going to do with this? And that's really kind of where it started from. I was pretty heavily invested in the stock market. I'd been in technology and a lot of other areas. So I had a lot of tech stocks and things. And I was already kind of heavily vested there. And so I was looking at alternatives, something to kind of round out my portfolio. And had some friends who were real estate investors, and some guys on our board of directors of our nonprofit organization that were investors. And I thought, well, maybe I'll just do some real estate investing, just from a passive standpoint. And did some research, saw some markets where I thought homes were look like they're kind of in an emerging market. So I hopped on a plane out of Port-au-Prince, flew to Atlanta, flew to Memphis, came back with 3 turnkey rental properties.
Nice.
Next month, I started receiving, checks in the mail, and I'm going, "Oh, this is pretty cool," And I just looked at it as an investment. I wasn't really going to do anything, with these. I just thought the checks would just keep coming in. I wouldn't have to worry about it. But I thought, well, gee, maybe this could be a potential business. And I had started businesses. I spent 20 years in business, and part of that is an entrepreneur. And so I knew how to start businesses. I thought, well, maybe I could do like a little real estate investing business. And that's really where it started. And so I started piecing it together, started to do more research, bought another investment property in Indianapolis. And then, we flew back to the States for sort of a 1 year sabbatical to figure out if we really wanted to stay or not, or whether or not we would go back to Haiti. And while we're there, we decided, yeah, we really, really needed to stay. And so we still have our nonprofit in Haiti. That's, a big part of my motivation to actually get involved in real estate investing, because I want to be able to help the kids there through some of the proceeds as we start to build up our portfolio. So that's really how it developed. I got a little more serious. I said, hey, my goal is 1,000 units, and I'll just keep plowing forward. And once, we build that up, then, part of that will go to our nonprofit, and part of it will just be for us and for the legacy to be able to hand down to my kids and grandkids.
Makes sense. A lot of people get into it for that legacy, and it's always good to hear that there's another motivation behind it besides just the money. At the end of the day, you do a lot for the charitable work in Haiti, which is always good to hear. Took a look at your website, and I noticed that you're into multifamily real estate. And one of the questions that I had was, out of all the different strategies you could have gone into, there's single family rentals, there's turnkey, there's fix and flipping, there's all these various avenues, note investing. Why multifamily out of all these various strategies that were available?
Well, I was learning, and I'm still learning. I still consider myself a student, and I'm learning as I go along. And my first three properties were two single family homes and a duplex. Paid about the same for each property, but the duplex was making twice as much. Okay.
Yeah.
But I still, like these single families, I only had, one property tax payment, one insurance payment, one roof to deal with. So I was kind of going, it was kind of like a duh moment, where I
Yeah.
just kind of said, why am I wasting my time with single family homes when I could, plus when I have a vacancy, it's only a 50% vacancy as opposed to a 100% vacancy in a single family. So that just basically said, gee, if I can get these at the same prices I'm getting single family homes for, why don't I just buy a bunch more duplexes? But as I looked at it and I started to think about economies of scale, well, why limit myself to just a duplex? Why not look at 4 or 8 or 10 or 20 or 50 or 100,
Mhm.
that, really started me thinking. I could, yeah, it made more sense. I could, especially if I can get larger properties where I can have an on-site property manager, I can control what happens there a lot better. And so that's really what kind of kicked it off. And so the next property I bought was a 22 unit property. And then I saw that whole economies of scale just work out in an amazing way. And I could also see, sort of the multiplication effect that goes on when you increase rents, and how it overall increases the value of that property significantly. That, you can do changes to a single family home, but usually you're not going to go much beyond what the market will bear, right? In terms of
Yeah.
what rents you can ask for. And you really you can add all kinds of, upgrades and so forth, but you're still not going to surpass what the sort of the neighborhood, averages in terms of price. So that's what I liked about it, is that I could control the value of my property, just by value, just doing a value add type strategy and increasing, rents, decreasing expenses, and, boosting the ROI to the point where the value of that property increases significantly. And that's what really got me, is I just said, this is amazing. You can really, even in a declining market, you could have your property going up in value if you're doing a value add sort of play with it.
100%. That's the exact reason why I love multifamily, why I invest in multifamily, is because you could, by increasing rents, minimizing expenses, lowering expenses, you can increase that NOI and force the appreciation of those properties. It's something you really can't do on properties that are 1 through 4 units, right? So it's definitely a very powerful strategy. Question I have is, do you feel that an investor needs to start out in that single family or 1 to 4 unit space, or could they just go straight from, let's say, from zero to, like, say, 22 units, or do they need to build up that learning curve?
Well, it's interesting. At first, I would have said, yeah, it's better to start small. Get your feet wet. But most people, or at least a lot of people, especially my age, which is sort of my audience that I speak to, and my podcast and my website, and my blog and stuff, is yeah, they've owned a home before. So if you've gone through the process, you've gone through escrow once, you've worked with a mortgage company or a bank, and so you know how to finance it. The basics a lot of people already have that own a home. So why have to do that again? And one thing that's really very cool in terms of the folks that I speak to is I talk to a lot of investors that get started late in life, and some of these guys jump in and they'll buy 100+ units as their first investment.
Yeah.
And yeah, there are some different dynamics, and especially if you get into syndication and some other aspects of it. But generally, you're still buying a property, you're still signing escrow papers, it's not that different than buying a single family home. And you just have to be a little bit more, a little more specific in your due diligence, and dig a little deeper. And, you got to look at a lot more property than you do with a single family home. But overall, it's not that different. So, I talk to guys all the time that started off, you know, boom, with 100+ units, just coming out of, maybe they were in a program or a training seminar or what have you, where they learned about apartments. And why have to start smaller? I think it's almost better to start with more, because there are enormous advantages. You don't have to deal with some of the sort of minuscule property management issues that you do with a single family home. One thing that I notice with property management is I invest out of state. I live in Southern California. My properties are in the Midwest and the South. And I always have to deal with property managers. And if you're a single family owner, the property manager, you're one of probably 300 other, properties that he owns. So you're really not getting their full undivided attention. And sometimes you have to kind of vie for their attention and their interest in managing your property. Whereas you have a full-time property manager on site at your property, all that person is focused on is that property's success. And granted, you got to hire the right people, and they've got to be motivated. And you've got to keep them, monitored as well. But overall, that you've got a person whose full-time responsibility, 40 hours a week, is on your property and its success. Whereas if you have a bunch of multifamilies, you've got some property managers who are very divided, and have to deal with a lot of other properties and owners as well.
100% agree. From my experience, from everything I've seen, I started off as a multifamily investor, made a few limited partnership investments, and then was part of a team that syndicated 82 units. And we have an on-site manager, dedicated property manager, and it's just amazing on how seamless things run when you have that level of support in place, which is not really possible on the smaller units. Now, I've also been invested in with people who are in the smaller units. I think we had, what is it, 17 units across a 9-unit, 6-unit, and duplex in Kentucky. And we had that same exact property management situation that you're talking about right here, going back and forth, and there's all these problems, and it's just amazing. And I think it is really powerful when you look at those properties with the higher units that can support that property management, on how seamless it goes and how stress free. It's almost sometimes I feel like it's too good to be true in some
Right,
ways.
right. Yeah, and it's true. And I think it also, with the larger properties, attract a higher level of professional to manage that property too. Whereas, a lot of the folks that are managing the single family homes, yeah, they have to be a broker, but that doesn't necessarily mean that they really have a lot of experience in property management. Whereas you can actually, hire either a firm, a large firm that handles larger units, and have, them manage your person, or you can, oversee your own person. And I think it just has a higher level of professionalism, which reduces your risk to a fair degree.
I agree. I agree. I couldn't agree more. On your podcast, you discuss the passive. Passive investing is a big key, and I know for a lot of investors out there, passive investing is the goal, right? A lot of people just want the financial rewards of investing in real estate and don't necessarily want to do all the work. So, a question for you is: do you have any systems in place to make, or what systems do you use to make investing as passive as possible for you?
Yeah, I think that's key, especially for the folks that are in my ballpark, the baby boomers, the people that are they've already been out there. They've had a career. They've had a job. Okay, we don't want another job. We don't want, we really just, want to be able to sort of yield the profit, the benefits of having a property. But it's kind of, there's the various aspects. Like you said, passive income can come in many different shapes. I have people that are investors that want to invest in my projects, and they don't really want to know about the day-to-day management issues. They could, as long as you're meeting your goal, and you've set your business plan, and you're on target. They just want to get their yield, and they want to get their quarterly check, and at the end, they, whatever the exit strategy is, they get their little bonus, and boom, everybody's happy. So that's one degree of this passivity that a lot of people really are looking at, because you get the best returns in real estate right now than a lot of other options out there in the investment world. So there's that, and then there's the guy that, like myself, that actually has properties that I own and oversee. And for me, it's really, setting up systems that you can hand over exactly what you want and how you want that property to be managed. So when you bring in a property manager, you literally hand them a little manual and say, this is what I want. These are the reports I want. This is what I expect you to do in terms of the number of showings, and I want evidence that those showings occurred, and I want to see the sort of your top candidates for tenants, and in various aspects like that. As you get more confidence in the person, you can ease up a little bit. But it's important early on to set up systems that allow you to be able to, imagine you're creating a franchise, and that manual is going to be something you're going to hand on. And literally, that's kind of my thought, because I have a son who loves real estate investing. He's only 19, but he's really interested in it. I want to be able to have this little manual and hand it to him and say, hey, I'm done. You can take over the family business, and and I'll just be part of the happy investors. So, but I think that you almost have to go in there with that idea of create. You can't say it's not a business. Even if you own one property, you're in the real estate business. You've got one. You're a CPA, right? So it's you've got profit and loss. You've got all these expenses. You're running a business. And so why would you want to run it any less than, some of the top-notch businesses that are out there, that are franchises and very successful?
100%. And I love the fact that you said that about the systems and having a manual. I really do believe in systems, and that if you're going to build a business, it's imperative to document the way you want things done so that you can easily train people, hand it off to somebody else, and you can keep some controls in place. And the good thing about systems, especially for real estate investors out there who might be listening, is you don't necessarily even have to build a system yourself. You can go out there and buy a franchise that's already a system. You're buying a system, or you can go and get coaching and mentorship programs and what have you that can either give you the system or help you create your own system. I just can't stress enough how important systems are, and I'm really glad that you came out there and you said that there.
I think that's key, and something definitely that is our goal, and we're shaping it and changing it, as we go along too. We find some things that may have worked for someone else, or maybe you did come from a training or a program where they have theirs. So you have to adapt it to your style and the way that you do things as well. And but I think the overall core stuff, there's fundamental stuff that you have to have a good bookkeeping system. You have to keep good records. You have to, all those things. That's going to contribute to your success just as much as how you screen tenants and how you update your property and so forth.
100%. So one of the things I also noticed as I was browsing through the content that you had available was emerging markets is a recurring theme. So it's kind of curious to know what markets are emerging that you're looking into, as of right now in 2019 and going into 2020, and why are those going to be emerging markets?
Wow, you're gonna have me reveal all my secrets here. I don't know. Okay, only a few thousand people listening. Who knows? But there are certain areas, certain markets that are just sort of unrelenting. Okay, for example, if you can look at the Forbes, top markets, real estate markets, and so forth, and there's some that just keep showing up again and again and again, like a Dallas Fort Worth area. Okay, you can say, Dallas Fort Worth has been hot for the last 10 years or whatever. Really, maybe more the last 6 years. It's just been going crazy. And there's still good buys there, but it's also, it's the cap rates getting compressed more and more, and it's tougher to find the good deals and so forth. But it's still a good market. And why is it a good market? Because there are people moving there, and they're not slowing down. They're still coming into Texas, a lot of parts of Texas. But that's an area. As long as there's people that are coming in and there are jobs for those people, that's sort of the foundation. Those are sort of the first elements we look at. We look at population. We look at trends for the last 10 years, last 5, last 3 years, and we look at what areas have those big bumps in terms of population, and then we sort of overlap that with the jobs numbers. Then we have to look at what rental rates and rent ratios and so forth. And as you start to overlap, these overlapping sort of circles here, you start to have certain areas that just emerge, that just pop. And some of those areas, I'll give you general areas here, but
Yeah, I don't want to give any away your secrets. It was, of course, I guess I could have phrased it to be a little bit more general.
No, I'm just kidding. I don't mind revealing, because there's plenty of stuff out there. But I'm just kind of joking with you. But I think that those areas are constantly changing, and an emerging market, what you're looking for is probably anywhere from a 3 to a 7 year upward move. So you're looking at a bell curve, right?
Mm-hmm.
So the base of that bell, you want to get up there, and you want to be able to exit, not after you already reached the top of that bell, but the top of the bubble, so to speak. But where there's still some meat on the bone, where people want to buy in that area. And there's still plenty of people buying, for example, in a Dallas Fort Worth area, for example. But some of the areas that we're seeing some pretty dynamic growth are like the west coast of Florida. Certain areas on the western, mid southern portion of Florida. The Carolinas. There's one of the things that we're kind of experiencing on a nationwide basis is it's a seller's market. It's a seller's market on a nationwide basis, mm-hmm. But there are these emerging markets where there's buyer's markets, these little micro areas. But when you've got such a predominant selling market, you have to kind of move to secondary, tertiary markets where you really will see those real opportunities. And so, like in a Tennessee, for example, Nashville's been hot. It's also like a Dallas Fort Worth. Man, I wish I would have had 10 years ago. I wish I would have bought in Nashville. But there's still some good opportunities there. But then you start to look at areas like Clarksville, and it's not as big a metro area, but it's reaping some of the rewards of all these people moving to central Tennessee and stuff. So there are these other areas that may not not be as obvious, but they're within some. And then they've got some that are sort of within like sort of the top of the list is usually Pacific Northwest. You've got Washington, Oregon, Idaho, which are have been some of the hottest areas. Also, some of the most expansive areas too. But then you start to move into the secondary, tertiary markets. You may not look at Boise, Idaho, but you might look at Nampa, okay, which is a very short distance. Could be a commute to Boise. Places like Nampa are growing like crazy. Those are some of the dynamics you're looking at. There's places within a 40-minute drive from Portland, from the Seattle metro area, from these areas that really haven't been tapped yet. And so as we are monitoring, we're looking at single family home sales, for example, and single family prices, because multi follows single family. And so we kind of can see a little early what could be the next hot multi market. It may already be hot in terms of single family sales, but the multi always seems to follow. So those are some of the areas that we're kind of looking at. I still think that Central, I love Indianapolis. Indianapolis is what I call more of a slow and steady, not so much an emerging area. But, I bought a duplex in I guess it was 2016. Yeah, 2016. That's already almost quadrupled in price. Now that's the dynamic of an emerging market, right? But so there are pockets within the Indiana market where you can get those kind of returns. But I'd say most of it overall is a slow and steady, which is fine especially for us old dogs here, that are looking for that slow and steady. We want that good, solid return over a longer period of time. So we don't want to have to necessarily find somebody to buy the property in 3 to 5 years. I'm happier with a 7 to 10 year hold. or if it's something that's really good, why not hold on to it for 20 years? Yeah, I don't think the model that applied 4 or 5 years ago is the same model that exists today.
That's all great insight. And, one of the biggest things I think I picked out of there was, you have to look at the secondary and tertiary markets, because, sometimes the primary market there gets a little too hot, and, you have to go out. And, I live in New York, right? So I lived in New York City for a while. And one thing about New York is New York spreads out wide.
Yeah.
I imagine it, as these, say, for instance, Dallas or in Indianapolis, for example, as these cities grow, they start to sprawl out as well, and that's really when you see that growth in those secondary and tertiary markets. And even like you said, some of those markets may not even be experiencing high amounts of growth, but are just slow and steady, and those are the better for cash flow, the long term buy and holds, where it's a little bit less intensive, I guess you would say.
Right, exactly. And a lot of it too is just geographic. A lot of times you just get sort of an aerial view, and you can see two hot areas, two hot MSAs, and then you kind of look between them, just on a map. And you can see, pockets of potential growth there, because if it's again within that commuting distance, there's promise. But again, you have to have all the dynamics. You have to look at everything. Are businesses coming into town to provide those jobs? Is there maybe a Nike factory or an Amazon factory coming in? What are they doing on a local basis? Some of the city planners and so forth to attract business there. Are there tax incentives? Are there other types of incentives that would attract business to the area? So you have to have sort of all the ducks in a row to really know if that's going to be an emerging market or not. But I think there are those pockets out there if people just look and do their homework.
All great insights. One more question before we jump into a few of our accounting and tax questions, because of course we have to ask those. But are there any specific metrics that you look at when, say, buying or selling a property that stick out, that are just like important metrics in your mind?
Yeah, I mean, for myself, cash flow is our focus. So when we are, cash on cash returns, the cash flow for that particular property is, for example, most of the retired folks that are out there, they're looking either as something to supplement their existing retirement, or they're looking for something that will be their retirement. The cash flow is key. Equity is almost a secondary, tertiary down the road. Yeah, it's a great little bonus when it happens, but really, unless you've got that good solid cash flow, I mean, that, as far as a metric, if you can call that a metric, that's really what we look at first and foremost is what's the cash flow, how can you boost it, and what factors do you have in place that will to keep that consistently growing.
We've got to love the cash on cash return. So we do have to switch a little gears here into our tax and accounting segment. Nothing too crazy, but are there any tax strategies that you use to minimize your taxes and increase or maximize the cash flow on your properties or your overall portfolio?
Yeah, well, one of the first things that I experienced, which is really interesting, is that when I started investing in real estate, I was a 1099. I didn't have a W-2 any longer, and so I was coming in as a 1099 person. So I was just digging the tax write-offs that I got, okay, right off the bat, because everything I do is a value add sort of place. So had a lot of capital expenditures, had a lot of things that just brought my taxes to zero. Okay. And so like my first year as an investor, I'm going, oh yeah, I don't have to pay any taxes. I mean, I was in awe. But then, okay, I started to ramp up. Okay. And so, and I'm going into year 2 here, and I got pretty much zero income according to my tax returns. Okay.
Mm-hmm.
Well, trying to get financing. Okay. Going in there with zero. And this is something I didn't think about. I really didn't think about, is that, gosh, that it's a great thing not to have to pay taxes. But if you're going to try to fund, future growth, you want to be able to, get the best loans at the best rates, and you can't do that as a 1099 retired person. It's really difficult. So, to me, I'd say, what was my tax strategy? Well, my tax strategy in the beginning was to pay as little taxes as possible. But now as I'm really thinking, I'm looking at it, I'm going, man, should I set up a corporation or something, and to be able to, maybe even become a W-2 employee of my own corporation or what have you,
Yeah.
so that I can get these better loans. And now what I do find though, and this is, I guess you could say it's the part of a tax strategy, is that I really don't have to worry about that much anymore now that I'm syndicating, because really they're not looking at we're basically looking at non-recourse loans. We're looking at investors and sponsors and others that are going to be part of this package. So really, my tax status, in terms of the fact that I have zero income, at least on paper, looks it doesn't really matter as much anymore. And so, as I'm syndicating, I'm seeing that that's not as big an issue. But if you're trying to build up a portfolio, it is a big issue, because you don't want to get strapped with these. And like I did, I had to end up getting, not hard money, but it was kind of like the next step in between, in terms of funding some of these at, at 7%, something like that, which wasn't all that great.
That's interesting to hear because, for people, the end goal is to pay no taxes. But I guess at the end of the day, it does come down to your individual circumstances because while real estate can be great and on paper, you could pay virtually no taxes, I guess, in some circumstances when you're going to get financing, like you had just said, it could be a struggle. So that may not always be the most favorable or most desirable outcome for some people. So I guess that just goes to show the importance of tax planning and working with the right professionals, only because you don't know how these situations are going to impact you, which you might hear, on the internet, or you might hear out in, from books or whatever. It might not always apply to everybody. So, but that's interesting to hear that you couldn't get that the financing was difficult to achieve.
Yeah, I mean, I even had my accountant say to me, do you want to do like accelerated depreciation? And I go, why? I don't need any more. I don't need any more, deductions here. I mean, I just like, it was like a lot of people are looking for every little. I didn't have to, because of the type of investing I was doing, and the fact that I was constantly rehabbing or upgrading properties, and so I had a lot of expenses that I could deduct. So yeah, I never really got to get into any tax. Now I know what's going to happen now as I become more of a sponsor, and then I'm going to have a whole different situation. And there I need to really start looking at strategies that are going to make sense, so that I'm not losing all of my
Mhm.
all of my benefit there, and my investment, the returns that I'm getting. So
Absolutely. Things definitely do change up when you do go into syndication. The fees are taxed a little bit differently, so definitely a bit different. But on the accounting and bookkeeping side of things, how do you end up handling bookkeeping and accounting for your properties? Do you do it yourself? Do you have an in-house person? Do you outsource it?
yeah, it's kind of all of the above. I'm involved to a certain degree. We do, Quicken Online, so I can have an outside the bookkeeper, and I can access the records real easily, because we're sharing the data. My CPA can also access that same data, but I'm pretty involved in the process, because I want to make sure that the right things are being uploaded, and uh, my problem is okay, integrating that with property managers that use totally different property management software. So nobody's on the same, the same thing. There's sometimes they have to download raw files that I have to convert, or basically, get them to the point where they can upload into QuickBooks. So it is a little bit difficult. Yeah. Unless you can get everybody on the same plane there. So,
And we hear you 100% on the property management side of things. It's certainly challenging because there's so many different property managers use different property management softwares, and if you have multiple properties in different locations, you might have multiple property managers, and it's just trying to consolidate it out. Like you said, just it takes some manual work. So it is challenging, but we're working on a way to try to get around that, and we're hoping to make some progress on that soon. But
well,
definitely
tell
feel
me,
your
put
pain.
me on your list when you get that one resolved. I want to talk to you guys. I mean, I'm serious. That's like one of the biggest challenges. Plus, you have people sometimes in your property management firms, especially for the smaller properties, that may not have a real accounting background, and you find these items, expense items, going into the wrong, the wrong classes, or the wrong accounts, And so I have to periodically, just go through these things and scan these and say, no, that's a capital expense there.
Yeah.
That's not a maintenance expense. So that's, if you could find a way to sync all that stuff together. Well, I mean, ultimately our goal is to get everything, even all the property management in-house. That's ultimately what I'd like to do. And then we'll manage that whole process ourselves. But right now, with all these different properties in different places, it just makes more sense to have somebody local doing it, as far as the property management side. But I think the ultimate goal is to have not necessarily a property management company that's going to be doing other people's business, but having our own in-house property management person that oversees those properties.
Vertical integration, love it. So we generally ask our guests what their favorite technology is, but want to ask you what your favorite technology you're currently using is, and also add on another question: what's your favorite real estate investing book and why?
Whoa, okay. Well, there is one software that some of my property managers use
Mhm.
called Billium.
Yep.
And this is probably the best one I've seen. I've seen a lot of them because I've gone through a lot of property managers, unfortunately. But it's closer to where I would want to be. I mean, if I had to create my own, this is as close that I've seen to being an excellent technology for what we do. Um, Now, granted, I think there are a lot of proprietary type programs out there as well that would come with maybe a higher level of property management, but that's one that I really like a lot. Um, as far as gosh, that's always hard. I ask the same question to my guests too, and I always used to say, "Yeah, rich dad, poor dad," as a but really, it's not so much the case anymore. It's kind of interesting because I've kind of had like a, as I talk to people, they say books and I go, oh, let me check out that book. Let me, and I read them. I like Ken McElroy's stuff, the ABCs of Real Estate Investing, an advanced guide. Um, but there was this great book. It was not a lot of people know about it. It's by a friend of mine actually who lives here in Southern California, Martin Stone. It's called The Unofficial Guide to Real Estate Investing, and it's really just a real practical, not a lot of bells and whistles, but just how to be a good real estate investor. And they're like a little boutique brokerage that, whereas you go in there as an investor and you say, I want to buy a rental property, and they don't just go out and find a rental property. They have like classes for all their clients, and they come in free classes and they sit down and they teach you what real estate investing really is. And they've been doing this for 20, 30 years, okay, in Southern California, which is a tough market, but all their clients buy in Southern California, and which is like probably the most compressed, I mean, probably outside of New York, parts of New York, I mean, one of the most compressed cap rates there are. And yet all the stuff that they taught these folks went into this book that Marty Stone put together. And so that has become my sort of my favorite real estate investing book, because it's kind of like real estate investing for dummies, and which is what I need. So it's a good book.
No, I'm gonna have to add that to my list. I'm always looking for those like tactical how-to books that really just get down to like the brass tacks of how to do it. A lot of books
Right.
explain the concepts and great high levels, great for motivation and great for helping you understand new things. But when it comes down to actually putting the tire to the road, or however that phrase goes, those type of books are the best. What would be the best way for our listeners to get in contact with you or learn more about you if they wanted to do so?
Well, sure. The best thing is our website, and just so the folks know. I mean, our whole focus is our blog as well as our podcast is teaching sort of the latecomer here. The late bloomers, so to speak. That are either approaching retirement or in retire, so like 50 plus in age, that are getting involved with real estate investing. We just, we act as sort of an educational tool for them. I don't do any coaching. I don't have any programs I'm selling or anything. It's totally information. And I share a lot of my story as part of that, especially in the blogs, but in the podcast as well. But our focus is really for the one that just like starts later in life. We have kind of a different framework than those that are starting, like young guys like you that could come in. You've got, 20, 30, 40 years ahead of you. Whereas we're looking for quick return, and in a sort of a shorter term plan, so that we're not working full time. We're create a structure that produces the income that we want, so we can enjoy our retirement years. So that's our focus, and it's the website is it's called Old Dawgs REI Network. Dogs is spelled DAWGS. Okay, Old Dawgs REI for Real Estate Investing Network.com. And on there, is our podcast as well as our blog, but there's also a contact page there. So if anybody wants to write to me, get back to everybody that does, and you can just go in the contact page and ask a question or whatever it is, and we'll connect.
Awesome. We'll have that link in the show notes. Bill, it was a pleasure to have you on today. You gave a ton of valuable information to our audience, and we always appreciate when that happens. And thanks again for coming on. Look forward to releasing it.
Well, thanks a lot, Tom. And it's been great hanging out with you here. This is awesome.
Hey, everybody. It's Thomas Castelli here for the debrief section of this podcast. I want to thank Bill Manassero for coming on today. It was really an excellent episode, provided a lot of great value. And as you already know, Brennan was out today, so it's just me doing a solo. And one of the biggest takeaways I've got from the podcast with Bill today was when he started to emphasize the importance of systematizing your business. And I really believe that to my core, that is a key to success in business. And it's really, understanding what are the core functions of your business, what are the tasks you do on a day-to-day basis, and just documenting those. And the reason why you want to document those is because eventually you may need to have somebody else do that task. And what happens is you have all that knowledge stored up in your head, but it's nowhere to be found. And when you do document that, it makes training a lot easier. And, one of the things that I always hear when I talk to people about documenting their systems and processes and all that is it going to be good enough the first time? What if things change? Well, things are always changing in today's world. You're always finding bigger and better ways to do things and more efficient ways to do things, rather. And your documents, your processes and procedures, your systems are just going to go through iterations. You start out with the first one, you find a better way you find a better mousetrap, you go back to that document, you update it. But I really can't stress enough. And one of the good things about this real estate industry that we're all in as real estate investors is this isn't rocket science. This isn't anything new. We're not reinventing the wheel. I mean, unless you're in crowdfunding or something like that, you're innovating on the tech side, or you're trying to innovate real estate into the blockchain technology or something along those lines. Really, the core business model of real estate, regardless of what you're in, buy and hold, fix and flip, real estate syndication, multifamily, the core systems are out there, and there's a ton of coaches, there's a ton of mentors and consultants out there that can help you develop those systems and really shore up your business so that you can scale. And while I'm on that, I just want to throw out a few books. If you are interested in really systematizing your business and getting into a repeatable process so that you can hand it off to other people and that they can help you scale, there's some good books. One of them is called Traction by Gino Wickman. There's another one called The E-Myth Revisited by Michael Gerber, I believe is the author. And there's another one out there called Scale. I think it's called, it is by David Finkel, I think his name is. And really those books just give you a framework on how to systematize your business to turn to a scalable enterprise. Other things that Bill threw out there that were good, that were notable, were about the markets. In today's environment, the low interest rates since the early 2010s or so have really caused the price and really pushed and how hot just like the market and demand for multifamily is from investors have really pushed the prices up in these primary markets like a Dallas or like an Atlanta or some of these other major metros that you might hear about. And really, when you look in that secondary or those tertiary markets, that's where when you find the gold. I mean, I'm invested in a fund that one of the best performing properties is out in some town you never heard of. So you really never know. You have to look at the demographics. You have to look at the market trends and see where it's going. So those are some of the things that I saw that Bill came out that was really good. Again, I just really have to tip my hat off. Thank him for coming on the show today. It was an excellent episode. And jumping right into the Q&A section, we do have a question this week from a guy named Jeff. And Jeff asks, I'm a passive investor and used my self-directed IRA to fund a deal. And then I believe what you're asking, Jeff, is what is the impact of bonus depreciation and cost segregation study on my taxes? So that's a great question. So whenever you invest through a retirement account, like a self-directed IRA, you're really putting a tax shelter, which is real estate, into another tax shelter. And you lose a lot of the tax benefits from real estate when you do that. And let me explain a little bit further. So let's say you put a rental property into your self-directed IRA. Well, whatever income is derived from that property outside of UBIT, and we'll get to that in a second, is going to be tax-free because it's in the IRA. So, and what real estate does is bonus depreciation and cost segregation. They will increase and accelerate your depreciation expense so that on your tax return, you basically show a loss for tax purposes and you don't get taxed on your rental income. And that's really the core benefit of investing in real estate is you can use, again, 100% bonus depreciation and cost segregation studies to basically pay no taxes on your rental real estate when they're out of your retirement account. So when you go ahead and you put that asset into a retirement account, such as a self-directed IRA, the 100% bonus depreciation, the cost segregation studies almost become irrelevant. It's a non-factor at that point because you're not paying taxes. But that said, depending on the circumstances with your self-directed IRA, you may be subject to UBIT, the unrelated business income tax, if you use debt financing on your property. So whenever you invest through a self-directed IRA and you do get a loan or a mortgage, the percentage, this is the rough math, the non-technical version, the percentage of your property that is considered to be financed through debt, so let's just say 75% using a standard loan to value ratio, the 75% of the income derived from that property will be subject to the UBIT tax. And I guess to dig a little bit deeper, in that scenario, 100% bonus depreciation and cost segregation can cause a loss still so that you're, even within your retirement account, you're not generating any income and thus you're not subject to any UBIT. So that would be the benefit on your self-directed IRA specifically if the property was financed with debt financing, is that the 100% bonus depreciation and cost segregation would eliminate the UBIT tax, at least on the rental income from the property. You might still see some UBIT on the back end, depending on how big of a capital gain you have and how much of those the losses generated by the bonus depreciation and cost segregation study ultimately are left when you sell it. Last thing I wanted to point out here is that you are not subject to the unrelated business income tax, aka UBIT, when you invest in property that's financed by debt using a solo 401k. So if you have the ability to use a solo 401k over a self-directed IRA, and there are some custodians out there that can get creative and help you open a solo 401k, then I would absolutely recommend it because you're not subject to UBIT on properties that are financed with debt, which is going to be primarily most syndicates and pretty much a majority of the properties you're going to be looking at. So that's it, signing out for today. Hope that answered your question, Jeff. Looking forward to answering more in the next episode. And as a reminder, you can submit your questions to the Real Estate CPA podcast by going to www.therealestatecpa.com/podcasts and dropping your question into the box that's located right on the front of the page, and we may just answer it live. And to that same note, if there's any guests you want us to bring on, any topics you want us to discuss, go ahead and drop that in that box as well, and we may just discuss those or bring that person on. So thanks again. Tom Costelli signing out.
Thanks for listening to today's show. If you enjoyed the show, please find us on iTunes and leave us a review. You can also email us at contact@therealestatecpa.com with any feedback or topic suggestions. We are always taking on new clients, and with the new tax laws in play, you really don't want to navigate this alone. Let us help you save money on taxes and with your accounting and CFO needs. To become a client, navigate to our client page at therealestatecpa.com and fill out a web form with as much detail about your situation as possible. Thanks so much for listening. Have a great rest of your week.